Auzu billahi minash shaitanir rajim. Bismillahir rahmanir rahim. I seek refuge in Allah subhanahu wa ta'ala from Satan the outcast, and I begin in the name of Allah, the most beneficent, the most merciful. Hello brothers and sisters. This is the first video in the series of videos on the topic of Islamic finance and banking. And in this video, inshallah, we shall be discussing about the basic paradigms, fundamentals and core concepts relating to Islamic finance and banking. This video is brought to you by Renaissance Educational Empowerment for Awareness and Awakening. In this very video, we shall inshallah be looking at the definition of Islamic finance, the different terminologies, principles, its glorious history, how is it different from conventional finance, overview of Islamic finance industry, the performance of various Islamic banks, business model of a conventional bank in contrast to the business model of an Islamic bank, swift SWOT analysis, what the future holds, the key challenges, success and recommendations. What is Islamic finance? It is a system of financial activities consistent with Sharia based on Islamic principles, which at the core refuses collecting interest transactions involving uncertainty and speculation. It is based on the Islamic economic system and it is not restricted to Muslims only. Now, let us look at the terminologies of Islamic finance. The first is Takafful, which is Islamic insurance. Takafful is an alternative form of cover that the Muslim can avail himself against the risk of loss due to misfortunes. Then we have Sukuk, which is an Islamic bond. It is the Arabic name for a financial certificate but can be seen as an Islamic equivalent of a bond. The product tree of the various Islamic finance products. The first is the partnership-based mode, the second is a trade-based mode, and the third is a rental-based mode. Under the partnership-based mode, we have Musharaka and Mudaraba. Under the trade-based mode, we have Murabaha, and under the rental-based mode, we have Ijara. What is Murabaha? Murabaha is a contract for purchase and resale and allows the customer to make purchases without having to take out a loan and pay interest. Bank purchases the goods on behalf of the customer and resells them to the customer on an agreed profit margin. The customer pays the sale price for the goods over installments. Now Musharaka. Musharaka simply means a partnership. It involves you placing your capital with another person and both will be sharing the risk and reward in a profit sharing ratio, but the losses must be proportionate to the amount invested. What is Mudaraba? Mudaraba refers to an investment on your behalf by a more skilled person. It takes the form of a contract between two parties, one who provides the funds and the other who provides the expertise, and who agrees to the division of any profits made in advance. The bank would make Sharia compliant investments and share the profits with the customer, in effect charging for time and effort. If no profit is made, the loss is borne by the customer and the Islamic bank takes no fee. What is Ijara? Ijara is a form of leasing. It involves a contract where the bank buys and then leases an item. For example, auto Ijara is simply an agreement under which the vehicle shall be given to you on rent for a period agreed at the time of the contract. Bank purchases the vehicle and rents it out to the consumer for a period, upon the completion of which the consumer gets ownership of the vehicle through a separate sale agreement. The principles for the functioning of the Islamic finance industry is that it works on Islamic guidelines consisting of risk sharing, individual rights and duties, property rights, purity of contracts, commitments, transparencies and fair deals. Any predetermined payment over and above the actual amount of principal is prohibited as it is called interest. The only loan that is allowed in Islamic finance is Qardul Hasna, whereby the lender does not charge any interest over and above the principal. The Islamic financial system employs the concept of participation, utilization of funds on a profit and loss sharing basis. Now, let us look at the glorious history and evolution of the Islamic finance and banking industry. The pioneering effort led by Ahmad al-Nagar took the form of a savings bank based on profit sharing in the Egyptian town of Medghamar in the year 1963. This experiment lasted until 1967, by which time there were 9 such banks in the country. In 1973, the Islamic Development Bank was set up. The first Islamic bank in Malaysia was established in 1983. In 1993, commercial and merchant banks were allowed to offer Islamic banking products and services under the Islamic banking scheme. These institutions, however, are required to separate the funds and activities of Islamic banking transactions from that of the conventional banking business. The Islamic Summit of Lahore, Pakistan was held in the year 1974. It recommended the creation of Islamic banks and Islamic Development Bank. On the 14th of Ramadan 1420 Hijri, the Sharia bench of the Supreme Court of Pakistan gave its landmark decision banning interest in all its forms and by whatever name it may be called. The court also specified a step-by-step approach to rid the country of the evil of interest. How is Islamic finance different? Islam orders not to use money as a commodity, no time value of money, and profit cannot be made explicit. They operate under the concept of lender-borrower relationship, and the profits generated through this relationship are divided between the two parties as per the agreement. The bank entirely depends upon the fixed deposits and does not borrow money from the central bank. Bank gives loan on the basis of mutual agreement, and it majorly focuses on sales transactions. Let us have an overview, a bird's eye overview on the Islamic finance and banking industry. Islamic banking is growing rapidly in the world by 15 to 20% annually. It is estimated that 270 billion US dollars in assets is controlled by Islamic banks of the world. The total asset base of all Islamic banks is estimated at 950 billion US dollars. Future projections suggest that within 8 to 10 years, as much as half of the savings of the world's 1.67 billion Muslims will be in Islamic banks. This could represent 905 billion US dollars in total assets in Middle Eastern countries alone. Muslims living outside of the Middle East represent an even larger population, including countries such as India, Indonesia, and Malaysia, but also with developed countries, including the United Kingdom, France, Germany, the Netherlands, and the United States. More than 500 Islamic banks and investment firms exist globally, according to the Bahrain-based General Council for Islamic Banks and Financial Institutions. Islamic banks will hold 40 to 50% of the savings of the world's 1.67 billion Muslims in 8 to 10 years, according to the International Islamic Finance Forum. Islamic finance and banking is now worth around 1 trillion US dollars and is destined to grow more than 4 times the rate of conventional investing, according to analysts at Deloitte and Touch. A report released by the London-based Islamic Finance Information Service, Sukuk issuances in H1 2009-2010 increased by 29% in US dollar terms to US dollar 2.72 billion, a surge attributed to the rise in international issuance. Malaysian-based Islamic Financial Services and Saudi Arabian Islamic Development Bank are projecting the market to grow to US $1.6 trillion by 2012. Sharia-compliant assets reached about 400 billion US dollars throughout the world in 2009, according to Standard and Poor's rating services, and the potential market is 4 trillion US dollars. Iran, Saudi Arabia, and Malaysia have the biggest Sharia compliant assets. Let us evaluate the performance of some Islamic banks. Dubai Islamic Bank is 898 million. Al Raji Bank in the Kingdom of Saudi Arabia is 1.7 billion. Qatar Islamic Bank is 321 million. Abu Dhabi Islamic Bank is 303.2 million, and Bank of Islam Malaysia Berhad is 503.4 million. Now, the business model of a conventional bank. The conventional bank basically manages an interest-based pool, and it lends funds to debtors in the form of loans, and the debtor pay interest over the principal. The mode of credit is a PLS saving account, term deposit, and equity, and the customers of the banks are called the depositors, who are individuals, corporate firms, foreign investors, small and marginal enterprises, and public sector units. In contrast, the business model of an Islamic bank is Sharia compliant, and the main fund is called Mudaraba, which is managed by the bank. The other funds which operate in the bank are Murabaha, Ijara, Musharaka, and Sukuk, and the income generated through these financial products is in the form of profit, rent, and dividend. The mode of deposit and funding is a profit and loss saving account, CO2, and equity, and the investment account holders or the depositors of the bank are individuals, corporate firms, foreign investors, small and marginal enterprises, and public sector units. The key challenges facing Islamic banks are in the form of Sharia interpretation, Sharia experts, product development and execution, and competition from conventional banks. A swift SWOT analysis of the Islamic banking industry reveals that the strength is, of course, the religious appeal, zakat, innovative aspect. All bigger banks carry an Islamic portfolio because of its success. Islamic banking will unequivocally ameliorate the deplorable condition of the poor and marginalized segments of society. The weaknesses lies in the lack of standardization. There are differences in theory and practice, misinterpretation of Islam, conflict of opinion in different Sharia boards, and the opportunity is in the form that Islam is the fastest growing religion in the world with 1.67 billion adherents. Traditional interest-based banking is losing its value, especially after global recession. New markets have been emerging in non-Islamic regions, and the threat is that there are loopholes in its proper implementation and they lack research in products. I mean, the Islamic financial products are not as innovative as they should have been. The future for the Islamic finance and banking industry is that it will replace the interest-based conventional banking system with asset-based Islamic banking system. It will create awareness and propagate economic financial principles of Islam in new markets and economies. It will facilitate joint forums between Sharia experts and finance professionals. It will make certification courses in Islamic finance and banking accessible in new and emerging markets. It will develop uniform, standardized policies, practices, rules, and regulations in the Islamic finance and banking world. The success can be attributed to the fact that there are a large number of banks established specially for practicing Sharia compliant finance, but also from the increasing number of conventional banks such as Citibank, Hong Kong Shanghai Banking Corporation, which has started Amana with its headquarters in Dubai, Royal Bank of Scotland, Standard Chartered, Alliance Bank Malaysia, etc., all engaging in Sharia compliant operations. Now, NASDAQ has two Sharia index based indices. One is called Nasdaq 100 Index and the other is OMX Stockholm Benchmark Index. Dow Jones Indexes has been recently named the best Sharia compliant index provider for the fourth consecutive year by the Global Finance magazine. In India, recently, the Bombay Stock Exchange has launched an indices called BSE TASI's Sharia 50 Index. The recommendations: product innovation, ensuring innovative Sharia compliant products; service and product differentiation, top quality service to ensure that service standards of Islamic banking institutions is at par with conventional; aggressive marketing to ensure that Islamic banking reaches the tipping point in quickest possible time; to remove conflicting confusions and doubts from the mind of the general consumer; and Islamic banking rules should be uniform worldwide. Thank you very much.